And welcome back to the course on Forex trading. Today is going to be a very exciting tutorial because we will finally get to open our very own first real Forex order. That's right, I will be trading with real money right in front of your eyes. As you can see here, I've got a real Forex account open with Alpari and I have $500 on that account. On the left in the market watch, we can see that the market is fired up. The currency pairs are rapidly changing in prices, and in the middle here we've got the euro dollar 4-hourly time frame. We're going to open our very first order on the euro dollar. I have already outlined some things on this chart and we'll quickly discuss them before we go on to opening our very first real Forex order. As you can see, the price on the euro dollar 4-hourly time frame is currently in a downward sloping channel. So the borders are marked with these outer two yellow lines. The middle yellow line marks the middle of the channel. The price first entered the channel over here at the beginning on at the bottom border. Then it hit the top border a couple of times, hit the middle, hit the top border, went down, back to the bottom border, crossed the middle, went to the top border. Now it's just touched the middle. And guess where it's going to go next? That's right, it's going to go down towards the bottom border of the channel. So a couple of other things. Right here I've got some prices marked out. The green price is approximately the current price of the euro dollar. It's a bit higher than that currently. It's at 1.24319, so basically nearly 2 pips above that. The blue and the red represent where we would want to set our take profit and stop loss levels. So as you can see here, I've set the stop loss just above the top yellow line, meaning the top channel border, and that's because there's a good chance that the price will bounce off, and we'll give it some extra leeway in there because just in case it does cross the border a little bit, so we're on the safe side with our stop loss. Also, this red horizontal line represents a very strong psychological level of 1.25000 US dollars per euro, and that means traders will try to sell at that level, which will help us drive the price down. Also, we could potentially put the take profit even lower, closer to the bottom border, but I didn't want to make the take profit much larger than the stop loss. In this case, our take profit is approximately 140 pips, and our stop loss is about 130 pips. So that's about even, not exactly, but about even. You could, if you wanted to, set the take profit a bit lower, but we'll go a bit conservative and stick to this take profit of 1.22900. Also, an interesting fact that I noticed is if we go zoom out a little bit, you'll see that we are in a downward trend, so we are trading along with the trend, which is good. And an interesting fact, if we extend this channel line, you'll see that the price actually touched this line over here, so it is a diagonal resistance line for this trend, and that's also a good thing for us. It means there's even a higher chance of the price bouncing off this line when it gets to it, and that's exactly what we want. So now that we've identified the direction of our trade, where we want to set our take profit and stop loss, the last thing that we have to do is understand what volume we can assign to this trade. And in order to do that, I'm going to quickly bring up a slide that we're already familiar with. To calculate volume of a trade, which is X in this equation, we have to divide the risk in dollar terms by 10 multiplied by the stop loss pips value. Here the stop loss pips value is at how many pips the stop loss has been set, and risk in dollar terms is the amount of money that we are prepared to lose if this is a loss trade. So in our case, let's assume that we're okay risking 10% of our balance. 10% is quite a risky approach. However, in our case, we've got a very strong resistance line. We've got another psychological level on our side, and so it does look like a good trade, and hopefully the euro dollar will go downwards and reach our take profit. So I'm quite comfortable at setting this risk level at 10%. Our balance is $500. 10% of $500 is 50, so we replace 50 in that equation. So the last variable that we have to input is our stop loss pips, and as we discussed, stop loss pips is 130, so I'll just put that in right now. And now I'm just going to bring up the calculator so we can work this out. So we're going to do 50 divided by 10 times 130, and that gives us approximately 0.03846. And of course, in volumes, in lots, we can only use 2 decimal points. Actually depends on your account, but on this account it's 2 decimal points. So we're going to round that up to 0.04. So I'll just type that in here. Equals 0.04 lots. Perfect. Now we can go ahead and conduct this trade. Now we're going to click this new order button up at the top here. And in these boxes, we're going to specify all of our parameters. So it's 0.04 lots. Stop loss, we're setting at 1.25600. Take profit, we're setting at 1.22900. That's the blue price over there. The comment is going to be my very first FX order, exclamation mark. And this is going to be a sell order, so we click sell, and there you go. The order has been sent successfully, executed, and it's got a ticket number. It's a sell order at 0.04 lots, euro dollar. That's the price at which it was executed. Stop loss and take profit just as we specified. So that's perfect, and congratulations on that. That's a very big step, very big first step in your Forex trading career. So I'm just going to click OK here. As you can see, we've got new exposure to the euro here. It is negative because we conducted a sell order. Here we've got some information on the margin and what's going on with the equity. Now if we move to the trade tab, you'll see your order here. So that's the ticket number of our order. That's the time when it was open. That's the type of order. It's a sell order. Size, the volume in lots, 0.04. Symbol is euro dollar. The price is that's the price at which the order was opened. Stop loss, take profit as specified. The price, this price is the current price, commission, taxes, and swap. And our current profit's a bit negative. That's because of the spread. Here you've got information, equity, margin, free margin, and balance. So that sums it up for today. We're going to leave the order for a few days and then come back and see how it went. Hopefully it would have closed at take profit by then. Thank you very much for your attention today. I look forward to seeing you next time, and until then, happy trading. Hello and welcome back. It has been 8 days since we opened our euro dollar sell order, and today we're going to look at the result. So right away, let's look at the bottom left corner of our MetaTrader 4 terminal. In the trade tab, we can see that our current account balance is $556.19. And that's great news. That means that our sell order was closed at a profit and we earned $56 on that trade. So I'll just quickly open the account history tab, and here we can see that our order is up at the top here, and the take profit is highlighted in green, meaning that the order was closed at take profit, and here you can see the profit is specified. So after subtracting swap, it's $56.19. So congrats on that. It's a really amazing feeling when you see a profitable order on your real Forex trading account. So let's look at how everything progressed. As you can see here, I've marked the time when we entered the trade with a vertical red line, and that was on the 25th of November 2014 at around 12 p.m. server time, and we entered a sell order. So what happened after that, I'll just zoom in a little bit. Our stop loss was set over there, our take profit was set here. So before we continue, what I'm going to do is I'm going to take this order, I'll drag it onto the chart, and you'll see what will happen. So as you can see, the order got drawn on the chart, so you can always do that. And if you want to see multiple orders, then you just hold shift and you drag the order, any order, onto the chart, and you'll see all the orders for that currency pair. But this is a handy trick to help you analyze orders. So as you can see, the order was opened there, then the price went back up towards the top of the channel, and it exactly happened to hit the top part of the channel where the channel border crossed the very strong resistance line of 1.25000, meaning that, as we discussed, there was a lot of pressure from traders to drive the price down. So as you can see, the price, I'll just zoom in a bit more, the price did go over the channel border a bit, but it went right back in without hitting our stop loss, and that's a good thing that we set our stop loss a bit away from the border of the channel, giving it this leeway, giving the price this leeway. Then the price went back down, and then it tried to test this level again, but it was a very strong psychological level. Plus, we're in an overall downward trend on the daily chart, so the price was driven down, and it actually went right down to the middle of the middle line of the channel. So if you extend this line, you'll see that that's exactly where the price bounced back off. So it was also a good thing that we've set quite a conservative stop loss, take profit, rather than setting at the very bottom line of the channel. We set it around the middle of the channel, and that's exactly where the order closed. As you can see, as the order closed, the price went back up, and that's like a very ideal situation, meaning that you took most of the momentum of the market that you could, so you couldn't place the take profit any lower than that, and that's just very precise take profit placing. So that's something you should aim for in your trades, to make the most out of the movements that you're forecasting on the market. So that's how it all played out, and that was our very first euro-dollar trade. Once again, congratulations on that, and look forward to seeing you on the next tutorials where we'll conduct more trades on this Forex real account. And until then, happy trading. Welcome back to the course on Forex trading. Today a good opportunity presented itself, and we will be conducting our second trade on our real live Forex account. If we look down here in the account history tab, you can see the result of our previous trade, which was a euro-dollar sell order, which closed at take profit and brought us a total of $56.19 profit. So now if we move on to the trade tab, you'll see that the current balance on the account is $556.19 of real money, which we will be using today to conduct our second real Forex order. So as you can see in the middle here, I've got the British pound dollar M15 chart open, and I've already got some markings on this chart which will help us conduct our trade today. So what I have here is first of all, and most importantly, is this moving average. It's a simple moving average, and the period is 96. So I'm just going to double click that, and you can see here that the period is 96. And the reason why I chose 96 is because there's 24 hours in a day, and there's 4 M15 bars in an hour. So if we take 24 and we multiply it by 4, we'll get 96. So that means 96 of these bars, of these M15 bars, actually represent one full day. And it's always good to have these reference points. So you could use 100 and it would look pretty much similar, but 96 has an actual meaning behind it. It means that you're averaging your price at a daily kind of rolling rate, at your daily rolling average. And that's a good thing to just keep in mind, so that you use multiples for your moving averages. Next, so what we can see here is that back over here a couple of days ago, the price crossed the moving average downwards, and this is something that using the moving average in trading is something that we discussed in the previous section of the course. And just to give you a quick refresh, what we see here is that the price crossed the moving average downwards and it just kept tumbling down. Then the price crossed the moving average upwards. It was uncertain for a while, but then it shot up and went really high, and there's a significant movement. So that's exactly what we'll be expecting this time. The price has just crossed the moving average downwards, and there's a bit of movement downwards, and then now there's a bit of uncertainty, but hopefully because the price is below the moving average, it will continue tumbling down. Of course, a situation like this can occur where there's a lot of uncertainty and the price just keeps moving around the moving average, and this is a flat market. However, there are other factors on our side that kind of say that probably the price will actually move downwards, that confirm our point of view. So, and those factors are, well, one of the main factors is that if we zoom out and we go to, for instance, the hourly chart, you will see that the price is in a downward trend. The British pound dollar is in an overall downward trend. So I'm actually going to go to the daily chart over here. Now if I zoom in a bit, zoom back in, you can see that the British pound dollar is in a downward trend, and I've even highlighted this channel over here. So just ignore the moving average for now, because it's a different moving average now on a different time frame. So on the daily time frame, you can see that the price is in a downward trend, and I've highlighted this channel that the price is currently in. And as you can see, it's bounced off the borders of the channel a couple of times, and now the price has come to the top border of the channel again, and that signals to us that probably it's going to bounce off backwards. So a very good confirmation from a higher time frame. That means that we are in a downward trend, and there is pressure from the market to push this price further down, and that's not something that you usually do. Usually you use lower time frames to confirm higher time frames, but it's also good to reference these things when you're trading on lower time frames. It's always good to trade in line with the overall trend and see what else is going on the other time frames as well. So we've got some good indication that probably the price is going to go down. I have already chosen the take profit and stop loss, and the stop loss we usually set just above the channel level, and we've also got some quite strong resistance levels over here. As you can see, the price was very uncertain around this level, around 1.57300 and 1.57400. So as long as we set it above over there, we should be in the safe zone. The take profit, well, we basically kind of look at a strong level over here. This looks like a strong area, so if the price does get here, it might to around 1.56500. It might kind of slow down, so we'll set our take profit conservatively just above that area, and hopefully if the price does turn around, then it will first hit our take profit. So that's the main bit. Also, because this isn't a very solid kind of analysis, it is in our favor. There is a high chance that the price will go down. However, it's not as strong as we had in our previous trades. So In this case, we would want to trade a bit more conservatively. So we won't risk 10% of our account. Let's say, for instance, we'll risk 5% of our account to be a bit more conservative. And the last thing that we have to do is check the volume, or calculate the lots for this trade. And for that, we will need the pips of the stop loss, as you remember. So currently the stop loss will be set at about 38 pips. So let's remember that when we're calculating the volume. Now, to calculate the volume, I'll bring up the slides from one of the previous tutorials that we're already familiar with. Alright, so now to calculate the volume of lots that we want to trade in this particular instance, we've got to take the risk in dollar terms, so the amount of money that we're prepared to lose on this one particular trade, and divide it by 10 times the number of pips in the stop loss. So the risk, as we discussed, will be setting at about 5% of our balance, which is 5% of $556, and that equals to $28. Let's put that into the equation. Now we've got to, the last thing we've got to input is a stop loss in pips, and that's about 38 pips. So let's input that now. And so that gives us, let's bring up the calculator, 28 divided by 10 times 38. That gives about 0.07. So let's put that in, 0.07 lots. Alright, perfect. So now we know what our volume is. We can go on ahead with our trade. Click this button up over here, new order. We're going to put in our lots right away, so it's 0.07. Stop loss, as we agreed, will be 1.57600. Take profit will be 1.56650. Comment is second order. Instant execution, it will be a sell order, so all set, everything's entered, and we click sell. Voila, our sell order has been conducted, 0.07 lots. We can close this now, and as you can see here, our order is in our terminal in the trade tab. So we're going to leave this order for a couple of days and then come back and see how it's going. Hopefully it won't take long, because this is a 15-minute time frame, and we're talking about movements of about 55 pips and 38 pips. So hopefully the market does go downward in this case, and we'll catch up again in a couple of days to analyze this trade. I look forward to seeing you then, and until next time, happy trading. Hello and welcome back. I just woke up and saw the good news, and I'm super excited to share it with you. So overnight, well, overnight for me, there was a massive movement in the British pound dollar in exactly the direction that we predicted, and as you can see here at the bottom, our trade closed at a take profit, and we earned $39 and $62 real dollars on the Forex market with this one single trade. So let's quickly have a look at how it exactly played out. I'm just going to take this trade and drag it onto the chart. As you can see, it's now being placed on the chart for me. So now if I change these to bars and I zoom in a bit, we can see that's our trade over there. So what exactly happened? This red line indicates where we entered. So we didn't know any of this so when we conducted our trade, and the price did come up a bit closer to the moving average again. It bounced off the moving average and went straight down. And as you can remember, the way we set out take profit was just above this strong support line at about 1.56500. Yes, strong support line, and because the price had a potential to be uncertain around that
level and jump back from it. So we set our take profit at a conservative 1.56650, so 5 pips above that line. And as you can see, that's exactly what happened. The price was very uncertain around this line, just as it was back here in the previous days. This line was quite a strong support line, so the price did exhibit some uncertainty around this area, even though it did eventually bounce up and then down. So we could have earned potentially more profit if we set our take profit here. In this particular case, we did exactly the right thing by setting the take profit just above that area, because there was no guarantee that the price wouldn't go straight back up. And moreover, imagine sitting in a trade, and if your take profit set over here somewhere, and seeing all of this and seeing the price go back against you. There's a strongly negative psychological experience when you see this going back up. And that's psychology, something we'll talk about at a different time. But in any case, never beat yourself up if you didn't take the whole movement. In this case, we got what we were aiming for, and that is perfect. So there you go. That's a good real example of how to trade the moving average on the Forex market. And just before we finish up today, I wanted to say that a good rule of thumb is to look at the moving average as a moving support or resistance line. So usually your support or resistance lines are horizontal and they're static. However, the moving average can be regarded as a moving type of resistance or support line. So in this case, as soon as the price went through the moving average, it went down, and then the price went back up, tried to test the moving average, which in this case became the resistance line. It couldn't go through, and then tried to test it again, couldn't go through, then went straight down. We got our profit, and that was the end of this trade. So have a look at the moving average in that new fashion, and if you find the kind of right period of the moving average for your chart, then you can actually have quite successful trades through this method. Actually very successful trades if you do the analysis properly. Thanks for your attention, and I look forward to seeing you next time. Until then, happy trading. Come back to the course on Forex trading. Today we'll be conducting our next trade on our real live Forex account. So today we'll be trading the Australian dollar, Canadian dollar 1 hourly time frame. And I'd like to mention that the Australian dollar, Canadian dollar currency pair is quite interesting because it consists of two commodity currencies. The commodity currencies on the Forex market are the Australian dollar, Canadian dollar, and New Zealand dollar, and they're called such because the economies of the respective countries heavily depend on commodities such as grain, timber, oil, natural gas, and so on. And so the movements of these currencies are often dictated by and correlated with the movements of those commodities. So trading the Australian dollar, Canadian dollar has its own specifics, and it's quite interesting in times. So I think this will be a good example to kind of illustrate what other currencies they are, that currency pairs they are that don't involve the American dollar. So as you can see on this account, we already now have $595.81. If we go to the account history, we can see our two profitable trades from previously. And what we're going to do today is we're going to conduct our third. So on this chart, I have highlighted some things, and right away you can see that the Australian dollar, Canadian dollar currency pair has recently been in a channel. So the currency started bouncing around in this shorter channel, and then the channel expanded, and that sometimes happens, and so the lower boundary became the middle line of the channel, and now the currency has been bouncing in here for a couple of days, actually since Christmas. So now we're in January 2015. Happy New Year, by the way. And so we're going to conduct this trade now. One more thing, if we zoom out, we can see that generally speaking, it is a downward trend. So what's happening right now is a retracement, and we should be very careful when trading these, because The currency can turn around at any point in time. So that's why we're going to trade quite conservatively, setting our take profit, not even at the very end of the top border of the channel, but rather around this high that we had seen previously over here. Also, what you will see is that there's a level here, 0.96. So I'll just point it out here. Just above the blue line, there's a level 0.96. And that level is quite strong, a quite strong resistance level, as you can see here, here. Traders are generally afraid of it, so I'm quite skeptical about the price crossing this level. So we're definitely going to set our take profit below that level. So we've got the take profit set. Well, we will set the take profit here. We'll enter at market price, and the stop loss. Well, the stop loss I chose to set just below the 0.95 level, because the 0.95 level is quite a strong support level, and we can use it to protect our investments, so include it in our strategy, and expect if the price does go down, then it might bounce back off around the 0.95 mark. And that level has proven, like you can see here and around these areas here, you can see that level has proven to be quite strong when the price comes towards it. So without further ado, let's move on to calculating the risk, and then we can open the order. For calculating the risk, we will need to know stop loss in pips. So here we have approximately 73 pips for our stop loss. So I'll just bring up the slides from that we're familiar with. So we need to take the risk in dollar terms and divide by 10 times stop loss in pips. So in our case, we want the risk in dollar terms to be approximately 10% of the balance, and that's because we're taking a very short trade. We're not going to ask for a big movement, and it is quite a good signal, even though it is in the counter trend movement, but at the same time we are headed towards the top of that channel. So 10% of 595.81 is approximately $60. So we put that into the formula. And now we can also plug in our stop loss in pips, which was approximately 73 pips. And now if we calculate that, I'll just bring up the calculator here. So 60 divided by 10 times 73 makes it 0.08 lots. So that's good. Now we can exit this presentation. Screen pops up, and so we'll type in 0.08 lots. Stop loss is 0.9480. Take profit 0.9590. Comment my third Forex order, and instant execution. We want to create a buy order. Everything's ready, just double check very quickly, currency pair is correct, click buy, and voila, the order is ready. 0.08 lots. If we go into the trade tab over here, we can see that the order is up over there, and right now we're in a bit of a minus, and that's because of the spread. So we'll leave it at that and check back in, hopefully maybe today. So these vertical lines, these are period separators, that means a new day according to server time. So maybe today, maybe the day after, hopefully we'll get a result, and hopefully we'll get a take profit on this order. I look forward to seeing you in the next tutorial. Until next time, happy trading. Hello and welcome back. It has been just over 20 hours since we opened our Australian dollar Canadian dollar buy order, and we have a result. The buy order was closed at a profit, and we can see this from the account history tab down here. As you can see, the green indicates that the order was closed at take profit, and this single order brought us $22.74 of real money from the Forex market. So congratulations on that. Right now our account is sitting at a total of $119.20 profit, and as you recall, we started off with simply $500 on the account. So if I bring up the calculator now, and we divide $119.20 by 500, we'll see that in total we have earned over 23% of profit just through these 3 trades. That's an incredible result. It is a result of very precise entries and exits and very well calculated risks. So we'll talk more about that in the summary for this section. And for now, let's just quickly have a look at how this order played out and what we can learn from this particular trade that we conducted yesterday. So as usual, I'm going to drag the order onto the chart so we can see it there. And I'm going to change the chart to a bar chart so we can see things a bit better. And if we go zoom in a little bit, we can see here that the order was opened where the red line is, and that's where we entered the position. Then from there the market went a little bit down, kind of crossed over this channel line, the bottom of the bottom border of the channel, hit the moving average, crossed it a bit, tested it, and then went back up slowly to where it's supposed to go. So a couple of learnings from this particular example, or from this particular order. First one, and one of the most important ones, is that it's really good that we set the stop loss in this position where we did. And by that I mean that a lot of the time traders tend to set the stop loss right under the channel, right, like right over here or maybe over here. As you can see, in this case it wouldn't have worked. The market tends to test resistance lines and borders of channels, and by that I mean that it can approach them and even go through them a little bit and then go back. So finding a good position for a stop loss is a crucial part of your trading. In this case, I'll remind you that we looked at the psychological level of 95, and that was protecting our stop loss, so we set our stop loss below that level. Also definitely it has to be below this bottom border of the channel. Another interesting thing about the stop loss is, and this is something I didn't mention yesterday, but it's good to analyze it today. As you can see, the stop loss was also protected by the moving average. So not only the 95, not only the channel border and the 95, 0.95 psychological resistance level were protecting a stop loss, but also the moving average was. And so this is a 96 a simple moving average, and 96, there's 24 hours in a day, and if you multiply 24 by 4, you'll get 96. So this moving average kind of represents the average over 4 days, the average on the hourly time frame over 4 days. And as you can see, in this particular case, the moving average works really well. The price bounced off the moving average here, then bounced off the moving average over here again, then bounced off the moving average here again, and yesterday, after we conducted our trade, the price also once again bounced off the moving average. And that's a very good example of how you can use the moving average as a moving or rolling resistance line. So in this case, that was another good thing for where we set our stop loss. And finally, if we look here at the take profit, what happened here is the price has reached the take profit, which is great, but it has not yet reached the top border of the channel. So there is a potential for the price to keep going, and maybe that will happen. But if you recall, the way we set this take profit was it had to be below the important psychological level of 0.96, which is here, which I'm currently showing with the cursor. So this is also a very crucial part of your trading, to set your take profits at strategic levels, like below or above. In this case, we know that the traders will be hesitant to cross the 0.96 line, and therefore statistically it kind of reduces your chances of profit if you set your take profit above this level. So sometimes it is worth being a bit more conservative and setting your take profits below these levels. So being kind of, rather than just going for big bucks, being more strategic about your trading. So those are kind of the learnings from this example and or from this particular trade. And I look forward to seeing you in the next tutorial. Until then, happy trading.
Welcome back to the course on Forex trading. In today's tutorial, we will be conducting our fourth live trade on a real Forex account. So as you can see here, down at the bottom, we've got our 3 profitable trades that we've had so far and that have brought us $119.20. And currently on this account, I have $619.20 of available funds. So today we'll be looking at the Australian dollar, American dollar hourly time frame, and here we will be investigating a very interesting formation which we have not talked about yet. So this is a Gartley and Pesavento harmonic pattern. And before we go into detail on this particular formation, I just wanted to show you how you can read a bit more about these type of patterns. So if you go to Google and you type in harmonic patterns, and then you go for, we'll go for the images just to see them, you can find a lot about these harmonic patterns. And for instance, here is a good summary of the 6 harmonic patterns: the crab, the butterfly, the bat, the Gartley pattern, the 3 drives pattern, the ABCD pattern. So if you scroll down here, you'll see that there's a lot of examples, there's a lot of analytics around them, there's a lot of good explanations. So in this particular case, the pattern that we're going to be looking at is the butterfly, the Gartley butterfly pattern. Harmonic patterns are very interesting and they're based on Fibonacci numbers, so there's a lot of mystery around them. I used to trade them quite a lot back in the day. You can write a whole course about harmonic patterns, and that's why we won't go into too much detail about them in general. However, today we will look at the butterfly because we are working with it. So what you're looking for in harmonic patterns is either a kind of shape, candle formation in the form of a letter W for a sell, or in the form of a letter M for a buy. In this case, we have a very, very well pronounced Gartley butterfly. And the W formation is kind of just something to get your attention, but that's not actually enough for a formation to be a harmonic pattern. The word harmonic implies that there are Fibonacci numbers involved somewhere. So how are the Fibonacci numbers involved in this case? So if we take the Fibonacci retracements up over here, and then we drag them onto the very first movement in this formation. So we drag them here, and then we move back. You will see that this line, 61.8%, happens to fall exactly where the retracement, the second movement, ends. So that's why I marked it 61.8% here. So, and that's no coincidence. This is a downward trend. The retracement was 61.8%, and that is a Fibonacci phenomenon, call it that if you will, or it's just a harmonic movement. So, but the interesting thing about Gartley and Pesavento patterns is that there's multiple ratios like this in one pattern. And for instance, if we keep expanding this to the right, you will see that the last movement over here, the fourth movement, was exactly 127.2% of the original movement here at the start. And these two things happened at the same time. So how do we get 127.2 from the Fibonacci ratio? Well, if we bring up the calculator and type in 1.618 and take the square root of that, then you'll see that the square root of 1.618 is actually exactly 1.272. And that again is not a coincidence. That is where all the mystery comes in. Nobody actually knows why markets move like that. Why is it exactly 61.8% here, and why is it exactly 127.2% here? In fact, this ratio can be a bit different. It can be the full 161.8%. It can be another harmonic ratio. But the fact is that there are harmonic ratios involved multiple times in these formations. Regardless of the fact that nobody knows why that happens,
you can still take advantage of them and use them as strong signals for you to enter the market. So in this instance, we have a strong sell signal. Oh, by the way, before we move on, I just wanted to show you that in your Fibonacci properties, if you ever want to add a level, like for example 127.2 is not a default level, you just click the Fibo levels tab and you click add, and you can just add any level over here. So that's pretty simple. Okay, moving back to our pattern. We've got this pattern ready to fire, and one more thing that it actually gives you is it gives you targets. So Fibonacci Gartley patterns, they actually give you targets where to set your take profit and stop loss, which is very convenient at times. So the way you set the take profit is you take this last movement, you drag another Fibonacci retracement onto it, and then you look where you have the 161.8 level, and that's probably where the price is going to go up to. Statistically, it happens that way most of the time, more often than not anyway. So you might want to set the take profit here. But in our case, we have a very strong support level, 0.8, which the price, or 0.80 actually, which the price has not been able to surpass 2 times already. So it is quite a strong bet that we will go through this level, and that's strong enough already. So that's why I wanted to set the take profit a bit closer, a bit higher up, because there's another level over here which is 0.79, which just happens to be on the 161.8 line, or just above it. So I want it to be above this other support line. So if we do break the 0.80 level, then we don't have to worry about the 0.79 level. So that's how you kind of establish where to set your take profit. It's either at 161.8% or 127.2 if you like. I'm setting it over here, somewhere in between. Your stop loss, well, kind of similar thing. If you drag the original Fibonacci retracement, your stop loss, it's good to set it above the 161.8 because this acts as a resistance line. Also, we've got a strong level here, which is 0.83, and as you can see over here, 0.83 was a strong resistance line. It's also a psychological level as well. So it's good to protect our stop loss in that way. Finally, if we zoom out a little bit, you will see that we were in a downward trend, and so there is a more kind of evidence or support for us to say that the trend will continue in that direction, which is good. It's always good to trade in line with the overall trend. So right now we're all ready to set our order, and the last thing that we want to do right now, I'm just going to probably delete these Fibonacci lines. Last thing that we want to do is we need to measure our stop loss, because we'll need that for the risk calculation. So right now there's about 195 pips in the stop loss. Let's remember that number and move on to calculating our lots. Alright, so to get our lots, we have to take the risk in dollar terms and divide by 10 times the number of pips in our stop loss. Because this is quite a risky trade, we're trying to break the 0.80 level. I would rather go a bit more conservative here, and that's why we're going to take about 5% of our balance as opposed to the 10% that we sometimes take. 5% of $619.20 US dollars, 31 US dollars. Let's plug that into the formula. And so the last thing that we have left to do is to type in our stop loss in pips, which is 195 pips. So let's calculate all of this. 31 divided by 10 times 195 gives us about 0.0158. So you can round this up either down or up. I'll round it up in this particular instance, and that'll give us 0.02 lots. Alright, that means that we're ready to set our order now. So now I'm going to click the new order button up at the top here. This will bring up the new order screen. I'll just zoom out a bit so we can see everything at the same time. Alright, so our lots are 0.02.
Stop loss is 0.8350. Take profit is 0.7950. Comment, let's call this fourth order. We'll call this Gartley butterfly. Oh, it doesn't fit. Let's just call it Gartley butterfly, and at the start might say number 4. Alright, so now we're going to just quickly check that everything's correct, and we're going to sell. Perfect, so there's our sell order over here, and it's all in the market. We just have to wait for the price to hopefully go in our direction. Alright, so we'll leave this order alone for a couple of days, and I look forward to seeing you on the next tutorial. Until then, happy trading. Hello and welcome back, and right away, congratulations. It has been 11 days since we opened our order according to the harmonic patterns analysis, and yesterday the order closed at a profit. So you can see the profit over here. It's the last order in the history, $41.74. So I'm just going to drag it onto the chart so we can see how it played out. And here you can see we opened the order here. So we didn't know any of this part. All we saw was these 3 downward bars, and that's where we made our decision to sell, and we opened the order. Just for comparison, I'm going to bring up the a snapshot of the screen when we made our order. So you can see it here on the left, and as you can see, we didn't know any of that movement. It was a purely technical analysis decision. We saw the harmonic pattern, we saw the Gartley butterfly, and we decided to enter. And now, as you can see, 11 days later, we have been rewarded with a take profit. So that's beautiful, just an amazing result. Let's quickly have a look at how the market played out. So I'm just going to zoom out a bit. Here you can see a bit better what happened. So we had, or maybe even a bit more. So we had this downward trend. Then we had a bit of a consolidation when we got to this is the 0.80 level. Here it is. So this is the 0.80 level. The market was very unconfident getting to this level, and you can see how the power price bounced off a couple of times, and by doing so it formed this harmonic pattern which we actually use for our analysis. Then the price went down at this stage. It kind of tested the it got to the 0.806 level, kind of there was a bit of pressure for the price to move upwards, went up a bit. It was a good thing, a really good thing, that we set our take profit up top here, protecting it with the 0.83 level. That's exactly what the price tested over here. So the price tried to cross the 0.83 level, but it didn't. Then a bit of consolidation again, and then it just started tumbling down, and that's where our take profit was reached. Beautiful result, very, very well set take profit in the sense that it's really stop loss in the sense that it's very well protected. A good take profit as well. And let's have a look and see where the price actually went up to. I think you might be a little bit surprised actually. So we're going to take the Fibonacci levels, and we're going to drag them onto our last movement of the Gartley pattern, and we'll see where they will end up. So we've dragged them like that. Now I'm just going to move them here, and what do you know? The price actually just touched the 161.8 level. Isn't that fascinating? That's exactly what we talked about in the previous tutorial. We said that the Gartley pattern gives you targets where to set your take profit, and something that I mentioned was you can either set it at 161.8 or 127.2, but we're going to set it somewhere in between because we don't want to cross the 0.79 level. We don't want to worry about it because the 0.80 level is strong enough. In practice, what actually happened, the price
touched the 161.8 level and bounced off, and it's a resistance line over here. Isn't that just fascinating that we had a harmonic retracement here, 61.8%, a Fibonacci ratio. Then we had a harmonic retracement here, 127.2%. That's the square root of the Fibonacci ratio. And now we have a harmonic movement, 161.8%. Just something to think about, how mysterious and yet very effective these Fibonacci levels and harmonic retracement patterns actually are in practice. So that's it for today. Congratulations on that great trade. Also, it was a good example, good illustration of the usage and effectiveness of harmonic patterns. If you're interested to find more about them, I encourage you to read on and find additional information, because they can be quite useful in your trading. I look forward to seeing you on the next tutorial, and until then, happy trading. Welcome back to the course on Forex trading. In today's tutorial, we will continue trading on a live real Forex account, and today is actually going to be quite a different tutorial. And that's because we're not going to open a market order, but rather we will open two pending orders on our account. As you can see in front of us here, we have the euro-dollar hourly time frame, and I've marked out some findings that I have located on the chart. So with the yellow lines, let's concentrate on the yellow lines to start with. We've got a triangle marked out, and we discussed triangles previously in this course, and as you remember, triangles mean that the market is kind of getting into a consolidation phase, or something that's going to happen just now in the market. And so in this hourly time frame, the euro-dollar has been in this triangle formation for several days. So these period separators indicate days, and that's 1, 2, 3, 4, 5, 6, about 5.5 days or 5 full days the market has been in this triangle. And as you can see, there's no escape out of this triangle. The only way the market can go is either up or down. It can't just continue in this triangle because it's coming to an end over here. So, and that's what we're going to take advantage of. But before we get into that, let's just have a look at how the euro-dollar has been moving in the past couple of months. So I'll zoom out a bit, and if we go back, you'll see here is another triangle that occurred previously. This was in January earlier this year, and as you can see, the price was in a triangle for several days, and then it burst out downwards. So I marked it with a red line here where the burst occurred. So that's that triangle over here. Then previously, before that, there was another triangle. Once again, the price was in a triangle for a while, and then it burst down. Before that, the price was in a channel. So I'll just zoom out. As you remember, we also discussed channels, and we used them in our trading quite a bit already. The price was in a channel, and then it crossed the border and burst down. Here, the price was in a triangle and then burst out upwards, but then still went down. Also, let's see if you can spot a channel right here. I'll just mark it out. So you can see a channel here. Let's change this to yellow. And there. So as you can see, the price was in the channel here and then burst outwards, downwards. So there have been a couple of instances where the price was either in a channel or in a triangle, and there was a burst. Another thing that you will notice is that currently we're in a downward trend, and all of these, both of these triangles that have already happened, and this channel, the most recent one, they all burst downwards. So it is much more likely that this triangle is also going to burst downwards, because we are in a downward trend. So the dollar is strengthening, the euro is declining. And that's important to remember, because that will tell us which trade is more riskier of the two. Another thing is that even though this triangle over here, it burst out upwards, the price still continued downwards afterwards. And that was because this temporary movement, this upward movement, was actually a retracement of the overall downward trend that we can observe. So if we zoom out even more, you can see that the euro has been in a downward trend for quite some time now. And so there's too many white lines now. All right, so that gives us a good indication that the downward trade is more reliable, the upward trade is less reliable. In fact, you might not even want to conduct this upward trend or prepare it, because it's quite risky compared to the sell trade. But we'll do both in this situation, and we'll manage our risks accordingly. So we've got our buy stop and sell stop ready. As we discussed previously, triangles generally tend to burst out for about half of their base. And so if this orange line marks the base here, then this is a copy of that same orange line. Then half of it is about where this little orange line sticks out, and same way here. Half of it is about where this little orange line sticks out. So it can burst further than that, but it can burst just about that exact distance, and that's where we will set our take profit. So this sell stop, as we discussed in the tutorial on pending orders, it will be triggered once the price crosses this line, and hopefully the price will keep going, and then it will trigger our take profit. So we'll set our take profit actually a bit higher than this orange line, and for the buy stop we'll set the take profit a bit lower than the orange line. The stop losses, for the sell stop we'll set the stop loss at the level of the buy stop order, and for the buy stop we'll set the stop loss at the level of the sell stop order. So that's all taken into consideration. The last thing we have to take into account is our risks. So to do that, we'll have to find out how many pips there are in the stop loss, and there's about 90 pips in the stop loss. So I'm just going to bring up the slides that allow us to calculate lots. So I've got the formula up in front of us here. For our sell order, we'll risk about 10% of our balance, and that's about 10% of $659, about $66. We'll plug that into a formula. Now all we have to do is enter the number of pips in our stop loss, which is about 90 pips. So that gives us 66 divided by 900, which is approximately 0.07 lots. Now let's perform the same calculation, but for the buy order. We're willing to risk less, about half as much, so 5% of our balance, and that's about $33. Let's plug that in, and doing this calculation, 33 divided by 900, and that's because the distance of the stop loss is exactly the same, and that gives us about 0.036, which is approximately 0.04. So let's put that in, 0.04 lots. So now let's create these orders. We click new order. For the euro dollar volume 0.07, that's going to be our sell order, sell stop. It's going to be a pending order. We have to click that. In a pending order, we're going to choose a sell stop. The price is going to be 1.1290. The stop loss, as we agreed, is 1.390. The take profit, I've got it written down here, so it's going to be 1.1250. And comment order number 5, sell stop. Just check everything very quickly. Looks good. And oh yes, we can also set an expiry date for our stop loss. So how about we set, we'll give it 2 days, or maybe it's even 1 day should be enough. So that is that's today. We set this day, tomorrow at about the same, well, not this, what time do we want to set? Yeah, let's give it just over 1 day. So we'll place that, click place. that's our pending order placed. It's hiding behind our sell stop over here, so we can our trend line over here. Actually, I think I set the stop loss at the wrong price, so this price should have actually been 80, not 90. And we'll just quickly correct that. So if we go to trade and we modify, this is how you can modify pending orders, and your stop loss should be just adjusted over here. It's very simple. Click modify, okay. So the stop loss is now hiding behind that blue line. And now we will conduct our buy stop order. So pending order, buy stop, 1.1380, stop loss 1.1290, take profit, I've also got it written down, so it's 1.1415, comment, this is number 5, buy stop. And expiry date, same thing, we'll let it expire tomorrow. Place. Okay, so let's just see if we can. Okay, we can't. If you want to see the expiry date, then you have to double click on the order and just check the expiry date. 2nd or 4th, or 2nd or 4th. Perfect. So you just need to quickly double check everything here. For instance, I can see right away that I set the wrong volume for the buy stop order, and I'm just going to therefore delete this buy stop order and reset it. So 0.04 pending order, buy stop 1.1380, stop loss 1.1290, take profit 1.1415, number 5, buy stop. Comment, actually expiry date, check everything, place. Okay, that should be done. So that's our sell stop, that's our buy stop. Everything else looks okay. So that was a good example of how you can quickly delete pending orders without any effect on the account, because they're actually not in the market. They don't really exist as market orders. They're just an intention for you to buy or sell. But you will still see your deleted order here, and you'll see in the comments, you'll see that it says cancelled because you manually cancelled this particular order. Okay, so we're just going to leave the account for a couple of days and see how all of this plays out. So either one of these orders or maybe even both will be triggered, and maybe nothing will be triggered if the price doesn't escape this triangle in the next 1.5 days. I look forward to seeing you in the next tutorial. Until then, happy trading. Good morning and welcome back. And congratulations. As you can see, the euro dollar shot through the top border of the triangle, triggered our buy stop, converting into a buy order, and hit our take profit at the top. So that's a fantastic result, and I just love seeing these things in the morning when I wake up. When you leave a trade overnight and even a pending order and you wake up and it's turned into a profit, it's just a fantastic feeling. Okay, so let's just drag this onto the chart and see how it went. Here you can't even really see it because it happened all so quickly within the space of 1 hour. So that's where we entered into the market. That's where our buy stop order was triggered and converted into a buy order, and then the price kept going up and triggered our take profit, and we got our revenue. So that's a great result. And if we look down here, you'll see that the buy stop order was changed into a buy order. So this buy stop order, it has nothing to do with it. That's the one where the lot size was incorrect and we deleted it. So here our buy stop order was triggered and changed into a buy order, and then the take profit was reached and we got our profit of $13.64. Now that doesn't sound like a lot, but let's put that into perspective. $13.64 represents approximately 2% of the balance that we had at the time. So we earned 2% in the space of several hours. That's incredible when you think that banks will only offer you a couple of percent, maybe 4 or 5% maximum on your savings deposit for a year. That's 4 or 5% in a year, whereas here we were able to make 2% in just a space of a few hours. So I'll let you think about that. What we're going to do now is an important bit, and we have to close or delete our pending sell stop order. So as you can see, the market has gone upwards, so this order has become obsolete, the sell stop, and we need to get rid of it because yes, it will automatically expire sometime later today. However, we don't want to risk just keeping it in the market because the price might still go down and trigger it, and that's not part of our strategy. So let's go ahead and do that. We'll go to the trade tab, and we've got the sell stop order here. All we have to do is double click the order. This window pops up, and all we have to do is simply click delete. And that's done. Now if we go back to account history, you'll see that we've got the sell stop order here. Now the orders are all ranked by their order number. If you want to rank them by the time when you close them, you just click time, and your sell stop order will be ranked at the bottom over here because we did close it last. Alright, so that's all for today. Just to sum up, in the previous tutorial and in this tutorial we saw how to use buy stop and sell stop orders, which was important. We learned how to modify them, how to delete them, and just generally how to use them in combination to create this kind of burst out strategy. And also we worked with the triangle, a very simple yet powerful feature on the Forex market. A good takeaway from yesterday's analysis was that if you see consistent behavior in the market, that the market is recognizing, for instance, triangle patterns, and one triangle burst out and then another burst out, and now you see a third triangle forming, then there's a good chance that this triangle will work too. So a better chance than if it's just the first triangle you're seeing on the chart. And that applies across all types of figures or all types of indicators that you might be using on the Forex market. And that just means that the market is in that type of phase, and all of the participants are also looking for those same patterns or figures or indicators. I'll leave it at that. We had a great trade, and now it's time to move on with the day. By the way, if you haven't yet left a review, please do. I would really like to know what you think about this course. I look forward to seeing you on the next tutorial, and until then, happy trading.